I've helped over 250 high-income W-2 earners save more than $12 million in taxes in just the last 12 months. So today, I'll show you 4 proven 100% legal moves you can copy and paste over to stop overpaying $50,000 and $100,000 a year in taxes. If you're new here, my name is Alec Friel. I'm the founder of Tax Saving Experts. I've been featured in Forbes over 6 different times, Yahoo Finance on 2 different occasions, Business Insider a handful of times. And what we do is we help high-income W-2 earners save $30,000, $50,000, $100,000 a year, and on average, they 3x their tax refund by replacing reactive April filing with proactive year-round planning and coaching. Let's start with a move you can set up today that creates real deductions and avoids capital gains at the same time. It's a simple shift in how you donate that unlocks major savings without changing who you give or how much. It's called charitable bunching with a donor-advised fund, and it works even better when you use appreciated stock instead of cash. So here's how it works. Instead of giving $20,000 every year, getting no tax benefit, you bunch multiple years of giving into one single year. For example, you donate $60,000 all at once, but not just in cash. You donate appreciated stock or ETFs you've held for more than a year. That way you get 2 major benefits at once. You deduct the full $60,000 and you avoid the capital gains tax on those appreciated assets. You still get to support the same causes you care about. You just do the giving through the DAF or donor advised fund over time. The charities get the money on your usual schedule, but you capture the tax benefit today. So let's say you usually give $20,000 per year. Instead, you transfer $60,000 of long-term or long-held appreciated shares into a DAF this year. That gives you a $60,000 deduction, which can lower your taxable income significantly and 0 capital gains on those assets. Then over the next 3 years, you send money through your DAF to your regular causes and nonprofits just like you always do. Just make sure the assets are held for at least 12 months. You stay within your AGI deduction limits, which are about 30% for appreciated assets to DAFs and 60% if it's cash. And you require proper documentation from the DAF from your CPA and financial advisor. That's how you turn feel-good giving into real audit-proof deductions that can actually move your tax bill. Now let's shift from giving to growing, because there's an account most high earners overlook that gives you a tax benefit going in, grows tax-free, and comes out tax-free. It's called the HSA, the Health Savings Account. And it's the only account with a triple tax advantage. If you're on a high deductible health plan, you contribute to one. For 2026, the contribution limits are inflation adjusted and higher than prior years, allowing roughly mid to 4,000s for individuals, mid to 8,000 for families, plus an additional $1,000 catch-up if you're over 55. Here's the power move that 99% of people miss. Don't use your HSA right away. Instead, invest it, the balance, save your receipts, let the money grow tax-free over time. Then reimburse yourself years down the road, completely tax-free. In retirement, you can also use it to pay for Medicare premiums, long-term care insurance, and keeps your retirement accounts intact. If you take money out before age 65, it's not for qualified medical expenses, you'll pay tax and a penalty. But after 65, it's taxed like a traditional IRA. There's no penalties. This is your healthcare war chest that builds while reducing taxes and giving you flexibility later. But what if you want a strategy that creates immediate 6-figure deductions against your W-2 income? Then you'll want to look at short-term rentals. Real estate gives you depreciation, a non-cash loss that reduces your tax liability. For most W-2 earners, rental losses are passive and cannot offset W-2 income, unless you use the short-term rental strategy I'm going to give to you. And here's how it works. You buy a rental property where the average stay is 7 days or less. You material participate, meaning you're actually involved in running the property. That's typically at least 100 hours per year and more time involved than anyone else, like your cleaners, co-hosts, or property managers. You need to also keep simple logs to back this up. Now those depreciation losses become non-passive and you can offset W-2 income. For example, buy a $500,000 property. Use a cost segregation study to accelerate depreciation. If you meet the short-term rental requirements, you could legally write off a large portion of that against your 6-figure W-2 income and wages this year. To claim the deduction for this year, the property just needs to be placed into service, meaning it's fully furnished, listed, and available for rent during this calendar year. And be sure you run it by your CPA. They're in a line so the elections and reporting are clean and the return tells the right story. If you want to learn more about how to use real estate to lower your taxes, then make sure to watch that video after this is complete. There's another lever almost every high income W-2 earner can pull and unlock real deductions and cut their their tax bill. That is starting a simple, legitimate side business. Pure W-2 life has limited deductions, but once you have real business, the tax code changes. Section 162 lets you deduct ordinary and necessary business expenses. Things like your laptop, your phone, software and AI tools, marketing, travel, legitimate home office expenses, even paying your kids for real work at the fair market value, which in 2026 is roughly around mid $15,000 per child. Depending on any IRS adjustments next year, this could change. This means you can reinvest before tax, reduce your effective tax rate, build a second stream of income all at the same time. As your profits grow, you can level up. Elect an S-Corp status to balance salary and your distributions. Use an accountable plan to reimburse yourself for expenses. And rent your home to your business under the Augusta rule and get tax-free income when properly documented. Just make sure you show a profit motive. Open a separate bank account, keep basic books. The IRS loves documentation. If it's done right, even a small side business can help you save $20,000, even $50,000 a year just in the first year. So to recap, you bunch charitable giving into a single year, use appreciated stock to get double the tax benefits. You max out your HSA, let it quietly grow into a tax-free healthcare fund. You run a short-term rental business to turn depreciation into a vehicle to offset your W-2 wages. And you start a simple side business that opens the doors to many more deductions. These are real strategies we've used with over 250 of our tax-saving expert clients to help them save over $12 million in taxes just in the past year. And now you've got the exact same roadmap. But don't stop here. We've only scratched the surface, especially when it comes to using real estate to lower your taxes. This video gave you the overview, but my next video breaks it down in full. How to choose the right real estate strategy for you. Short-term rentals, real estate professional status, how to time your deductions, how to use cost segregation studies the right way, the smart way, and how to put $50,000 to $100,000 back in your pocket this year using real estate alone. So if you're serious about keeping more of what you earn, watch the next video on the screen, how to use real estate to lower your W-2 taxes and get the full strategy step by step. And if instead you're a high W-2 earner making over $300,000 a year and you want a personalized plan built around your exact income, goals, and timeline, book your free tax strategy session using the top link in our description. This is where we'll help you design and implement a custom tax plan to lower your tax bill by $30,000 upwards to $100,000 this year legally and 3x your tax refund. And finally, stop feeling like taxes are slowing your wealth building process. Either way, don't wait. Small moves today beat huge regrets come April when you're filing. Your income should build wealth faster, not just fund the IRS, and you do nothing about it. We'll see you soon.